Hi, and welcome to Future Focus, a financial strategies podcast where we make the complex simple. My name is Troy Branch, and I'm joined here again for part 2 of our conversation by Keely Jo French.
Hello.
And Jacob Messick.
Troy, still Happy New Year.
Still Happy New Year. The New Year hasn't gotten any less happy in the time between episodes.
Yep.
All right. So what we're talking about today is continuing our conversation on 2026 is here. What do I do now? Personal Finance Edition. So we're gonna pick back up kind of where we left off, and now we're going to get into some some other sort of concepts and areas of planning, if you will, as it relates to what should I be thinking about from a personal finance perspective. And I'm just go ahead and do this now. This is anything that we talk about on Future Focus is not intended to be a specific recommendation. It's purely educational, and it's the idea that if we can help spark some thought, help make some concepts that may seem complex more simple, we've kind of done our job, and that's what we're going for. All right. So now if we remember part 2 or part 1, and by the way, if you don't remember part 1 or you're wondering what part 1 was, you need to stop this, go back and hit part 1, like and subscribe because you would be getting parts 1 and 2 and you'd be notified. But like and subscribe on part 1 and then look at that and then come back to part 2. How about we do all that? So those are sort of instructions going out. Okay, so if you remember in part 1, we talked about 3 things. We talked about budget, cash flow statement, balance sheet. Yeah. Now we're getting into some other things that we should be thinking about, at least at the beginning of the year, offers an opportunity to think about these things. All right. So one of the things that we know is the basis of sort of base planning, like we talked about. Planning to save, actually saving, and then sort of what the results are. One of the things that we talk about quite a bit in our day jobs is the role that insurance plays, that protection plays in sort of what someone is thinking about at this time of the year. Can you talk about why is life insurance in particular, but actually all insurances, all protection aspects, why is that so important to annually review, to think about?
Well, we want to make sure, life is fickle. Everything changes every once in a while. We want to make sure that the coverage that you have in place is actually sufficient to match the changes in your lifestyle. Maybe you had another child. Maybe you had an issue. Maybe you crashed your car. Who knows? If you need that car insurance, if you need additional health insurance, you just want to make sure that you're up to date and you're completely covered for whatever your needs are.
No, I think it's right. I mean, it's making sure, and we'll kind of maybe touch on the different type of insurance things that come to mind, that your current coverage meets, your current life situation. And like you mentioned, the beginning year is not the only time to be thinking about this conversation. It's a good time because, hey, at the end of the year, you're doing your cash flow, you're doing your net worth, your balance sheet. So this is part of that conversation, but you can still think about it throughout the year, but beginning of the year is still a good time to, hey, let's make sure you have that adequate coverage because, if something happens and you don't have the right risk management tools in place, that single event, an accident, a medical emergency, a property loss, that could derail your financial goals, both short, mid, and long term that you're trying to achieve. And, so that coverage, having that coverage in place helps make sure that the protections are there.
Whatever the insurance or the protection aspect is, whether it's property casualty, whether it's health, whether it's life, having those things in place.
Yeah, yep. And those were the things I wrote down, kind of what you had said, the home and auto. Making sure you have the right coverage in place for those properties. It's the...
Sorry, I said property casualty.
Yeah.
It's the umbrella coverage that goes with the home and auto. And what that is, before somebody makes me put one in there, it's that additional added liability protection that goes on top of your homeowners or your renters, your car auto insurance. And so it's especially if you have a higher net worth, or there's the added risks, it's having that in place as well too. You had mentioned health insurance. Beginning of the year or end of the year, beginning of the years is a lot of times that a lot of employers renew health insurance for their employees or individual coverage throughout the year as well too. You mentioned life coverage, life changes, bought a new house, new job, new addition to the family, making sure you have the proper life insurance coverage to meet your needs, and then even disability income insurance, not only protecting your, if something happens to you if you pass away, but also if something happens to you if you become disabled, your income replacement, your income's protected, so the income continues to come in the event you can't work.
Right. It's building, and this is just one of those sort of industry, sort of like it's building the moat, right? Like it's not exciting. Like it's not like looking at a balance sheet going up, right? It's not like I'm saving more, but it's building the moat. When something goes wrong, you're like, whew, that didn't derail me for the next 15 years.
I don't deplete all my emergency savings, and now I can't achieve my short and midterm goals, and I have to stop funding my retirement, my long-term goals.
Yeah.
That foundational level, those risk management tools. And so what we had taught, so life insurance, disability insurance, health insurance, auto and home, umbrella, all of those things are things to review. Beginning of the year is a good time for that, and working and talking with a financial professional if needed to make sure you have that right coverage in place.
Absolutely. Okay, so you actually just mentioned something that allows us to transition into another question. Like, so protection is the moat, right? That's the moat around the castle, and that's all the other things that you just mentioned. But what about let's go back to the stuff that people really get excited about, and that's the retirement, like saving forward and saving forward and taking the steps necessary to see that balance sheet go up. What should people be thinking about? To at the start of the year as it relates to their retirement. And by the way, retirement is sort of all of the above. It's retirement through a company. If I'm a business owner, it's what I've done personally. It's the idea of I'm now thinking forward about the dollars that at some point I'm going to deploy when when I get older and when I decide that yes, I want to retire from whatever I'm doing.
Yeah.
So I think the first thing that you should think of at the beginning of the year is maximizing your contributions, whatever your retirement form is or vehicle.
No, go ahead. I'm just looking. Okay,
You're looking at me like I'm about to get hit with the jargon jar,
I
and I do
won't
not
look
want
at
to get
you.
hit.
I
I was
won't
thinking
look-
about
sorry.
what I said.
Troy,
what did I say?
you can look at me. Look into my eyes.
Okay. No, you're looking at me like you better put one in.
No.
Anyway, so maxing out your contributions. Even if you can't max out the contribution that year, maybe you don't have enough funds to do that, that's fine. The very least that you should do, though, is you should try your best. Stop doing that.
Okay, sorry.
You should try your best to at least contribute enough that you'll get 100% of your employer match if there is one.
Yeah, and we talked about that. It's the employer match. It's seeing what did you contribute last year, and can you increase those contributions? Maybe if it's just incrementally, another 1-2%, or if you are trying to maximize and try and fund more than that. How close were you to those max levels for your 401k or your IRA or Roth IRA? All those terms we've used in the past, so nothing goes in there because everyone I know is
That was
listed.
last season.
No,
That was last season. If we're being technical about it, so we're saying the seasons carry over.
We say seasons carry over. Character development carries over, so it carries over. But no, it's checking those contributions and seeing if there's capacity to continue to fund and increase those, especially if you're, where are you at compared to your goals? So it's maybe looking at where you're at from your retirement savings to those future goals. Are you wanting to retire? We talked about this in prior episodes. When are you wanting to retire? What do you want that lifestyle to look like? So are you on pace for those goals? Do you need to contribute more to continue to make progress towards that? And then, there's things like, checking the beneficiaries of those accounts, making sure that those beneficiaries are still valid and accurate. You don't want those accounts going to the wrong person if something would happen to you. And, when Andrew was here with us, we talked about reviewing your investment portfolios and rebalancing the allocation. So that way, how your investments are selected, it meets your risk tolerance and your risk profile. So it's those type of things to make sure, hey, are my current plans still meeting my current goals, or should I make some changes and make those adjustments so I can be on a better path towards the goals I want to try to accomplish?
So let's go ahead.
And I know this isn't the estate planning episode, but I have to throw out that public service announcement. Please make sure you have a beneficiary designation. Put somebody down. The last thing you want is those funds going into your estate and being tied up in probate. So please make sure you have a beneficiary designation.
I actually like that. Not actually, probably wasn't the right descriptor word to put in front of it. Like, I'm shocked that you would come up with that.
No.
No, I'm not saying that. But no, that's actually really good because what you're describing is a continuum of stuff that happens. So like if you go, a budget, then cash flow, then balance sheet is the report card. How do you, what do you do to reallocate those dollars to your, like, how do you get Jacob, how do I add 1% to 2% a year? Well, it's sitting down and going through that exercise of, I spent more here, or I spent less here, so I now have dollars to reallocate. I made different choices because I know where stuff is going, and I can reallocate that 1% or 2% to the retirement plan, whatever it is. I can reallocate that 1% or 2%. That's how I come up with those dollars.
Yeah. Either come up with those dollars with different choices, or, hey, I already have those dollars, but instead of just spending them, let's deploy them so we can grow, for these more long-term goals. And then it's using the tools that are, whether it's the employers for the 401k website for the employer, or the investment platform that you're utilizing to actually implement those changes. Mm-hmm. And then I think another thing that comes up, we'll call it another service announcement, for, catch-up contributions. If you're like our friend Troy here, who's over the age of 50 and has the capacity for...
You just put my business out there like that?
Well, you're not young like us. You've said it. You've said in prior episodes that you were around 10 to 15 years away from retirement, and you do the math, and that probably puts you above age 50. But for those that are 50 and older, there's catch-up contributions. What that means, those are additional dollars that can go into retirement accounts. From IRAs and Roth IRAs, that's an additional $1,100 a year in 2026 that you can add to those accounts if you qualify to be able to make contributions. For 401ks, it's an additional $8,000 if you're ages 50 to 59, or $11,250 for ages 60 to 63. So there's the ability to, if you're getting closer to retirement, to put additional dollars in to help get ready and help work towards achieving those goals. So it's capitalizing on those type of abilities as well.
All right.
Not calling you old.
He's calling you old.
Yeah, in a roundabout way, he is. But there's a whole nother episode there with what that discussion, like, what does retirement look like? What is what's the utility of putting money in, putting more money in later? But again, this is not the episode for that discussion.
This all works together.
But we just got a topic.
The cash flow feeds into the net worth, which feeds into what am I doing for saving for long-term goals and retirement. It's all connected.
It all sort of feeds on itself.
Yep.
Absolutely. Okay, so you actually talked about something, and it was more from the estate planning perspective. But now we're going to move.
Do you hear that? Do you hear that sound? I kind of hear a blinker. like almost like we're taking an exit ramp to a quick little. You don't hear that blinker sound? I hear a blinker. New year. So, like last episode, we were talking about, this is another quick one. We're talking,
okay.
No, people like this. We were talking about, New Year's Eve. Do you go in? Do you stay out? Here's another one to talk about briefly. Start of the New Year's. A, do you guys do any New Year's resolutions? And B, if you do, is it personal non-finance, or do you have a personal finance New Year's resolution? So New Year's resolutions, do you guys?
I mean, technically, sure, but that's usually working out, and it doesn't work out within the first month.
I'm believe it or not, I'm not a New Year's resolution person.
No,
I'm not.
So I try, like Keely Joe, I try to be, thinking for this year, I think one thing, I'll kind of share what mine are. And, so from a non-financial side, it's trying to, we read a lot. Our team, hey, we're always reading, but I think it's more trying to read with a purpose. And so it's trying to read more books is from the mental side. And then, you always see things about like push-up challenges, trying to do a certain number of push-ups a day. And yeah, so I knew I'd get a smirk. I guess so. That's the goal for this year is to try. Now I don't know. Try.
How many? What's the?
We'll have to figure out what that right number is.
Are you doing these in office so we can have some accountability?
No, but so it's kind of doing that set number of push-ups a day. And I saw that one on LinkedIn, and that one's like, you know what? That's a doable one.
How many? Like what's the number?
I don't know. What do you think?
Because I might be able to get behind that.
Yeah. All right. I like that one.
Okay. Again, do it in office. Accountability. I need to watch.
Yeah. Okay. And then I think the finance one is like everyone.
I actually do that sometimes in my office. You guys don't see it.
You do push-ups in your office?
I do push-ups and wall sits and
hey, it's good for
and
you.
stretch.
I know my oldest son will be proud of me of that one. But then I think from a financial one, it's trying to allocate more towards Roth dollars. We talked about this before: tax deferred, tax free, tax deferred, taxable, tax free. Those Roth contributions, especially inside of a 401k, is just trying to allocate and utilize the Roth component more. So just kind of a New Year's resolution.
See, I'm the exact opposite, believe it or not, because I've been all in on Roth. Well, I was around when the legislation came through in '97, so that makes me, I guess that makes me the oldest. But so I was around exactly, right? So I was around when the Roth legislation and then Roth 401ks, I think was like 2006. So I've been all in on Roth for as long as I possibly could. So I'm Roth 401k as much as I can. But I have to do the exact opposite of you, which is I have to build up a taxable brokerage account because like we've talked about before, taxable, tax deferred, tax free, they each have characteristics and they allow you to plan as we talk about retirement moving forward.
Yeah, it's not an either or, it's a combination of all of them. So it sounds like we first started this question, New Year's resolutions are no. But
I don't do a New Year's resolution.
But it sounds like now you might be on board a little bit. So
no, I want to do the push-ups thing.
You know what?
Only because I want to go against you.
Midway through the year, come June, we'll have to do a half year check-in to see where we're at with all those.
Well, you got to give me a number first.
All right, we'll give you a number. Well, all right. So, dog just got done running around the rest area. Dad's telling us to get back in the car.
We still got.
We're back on I-80. Troy, you're back in the driver's seat.
All right. So we're going to transition now to, we got savings line, like we've budget and all the other stuff. We got savings line. We're doing stuff for retirement. So let's talk about our favorite thing here that almost always sort of gets the pebbles flowing, and that's tax preparation. Like, what do we think about taxes? How can the average listener take this January time of reworking and relooking and sort of restocking and prepare for tax season? What are some of your suggestions to help in preparation for tax season? By the way, tax season is technically April 15th. That's when we have to file our taxes. Hopefully people.
But doing things ahead of time, that means you're not rushing at the last minute trying to get everything all put together.
Absolutely.
Yep.
So just kind of like to make it a simple tax season is just making sure you're organized. Have all of your documents together. Make sure you collect them all. I know you don't have all of your documents. It's January. It's just like the very beginning of the year. Maybe you don't have your W-2 yet. That's fine. Or maybe you don't have your 1099s yet. Just make sure that you get your receipts together, whatever you've kept during the year, whether that's like HSA or HSA purchases that you need to defend or whatever you would like to report on your taxes.
W-2, 1099, HSA.
Okay,
We're just gonna let that slide.
Hold on.
We're just letting that slide.
I don't even know
You
what
need
she's.
to let it slide because every single U.S. citizen is a taxpayer. They should know what a W-2 is.
I don't
Maybe
even
not
know
a
what those
1099.
terms are. She's saying. All right. Well, we can compromise.
I don't negotiate with terrorists.
Troy was wanting you to put in 4. I'm willing to bring it. I really want to bring it down to 3, but I'm willing.
Where did we get 4?
I'm willing to bring it to 2.
I don't know.
2.
Inflation.
Yeah.
Okay, how about this?
One.
I would give you one.
One.
How about
1099.
how about one? Because it was all centered around sort of income items.
I hate all of it.
It was all in one sentence. So
I mean, like, but seriously, you didn't even blink. Like,
No, because everybody knows what a W-2 is.
everyone
Maybe-
knows.
Yeah, if you're
Are
a
we sure
taxpayer.
everyone knows? Are we sure everyone knows?
Do you pay taxes?
I
pay
know.
taxes? Do you
I
pay
expect
taxes?
you to know and
Do you
him
pay
to know.
taxes?
But
But see,
do you
I-
think every viewer knows?
I think that's
W-2, 1099, HSA. Okay,
Okay, HSA, I'll
All
give
right,
you.
well, there we go. HSA.
No, I think that's. I mean, that's people might not, and that's why. Hey, we're complex simple.
Yeah. We make the
May-
complex simple.
I feel harassed.
Maybe I need to sit in the middle seat to keep you guys apart.
Keep dreaming.
Yeah.
Okay.
But no, like what Keely Jo was saying, it's organizing those documents. It's getting all those documents that are related to your tax preparation together, and that way, and then it may also be reviewing last year's return. Kind of seeing, looking at deductions and credits are all part of the tax return to see if there's any changes to your situation that might impact your taxes for this year. And then I guess the last thing that comes to mind is also talking with a tax professional. I mean, if you have any questions, talking with a tax professional, especially we talked about One Big Beautiful Bill, if any of those changes that came out in July of last year impact your situation for this year, then it's talking with the right professional to make sure that nothing catches you off by surprise, or you're capitalizing on all the opportunities that came from One Big Beautiful Bill, or OB3 as Troy likes to call it.
As our team likes to call it.
As our team likes
For
to call
those
it.
of us who are team
I am
players.
firmly behind W-3. It's better than OBA or OBA. But yeah.
All right. So, for taxes, it's all those things, right? It's thinking about, let me see.
Making sure you have your documents, making
Yeah.
sure you're talking to a tax professional.
I was actually trying to think about how to say. I wasn't at a loss for words. I was at a loss for words and how to say it without having to put in a pebble.
my
That's what I was
bad.
thinking. I was thinking, how do I describe this and not put in a pebble? No, I was just thinking, just like when you talk about a tax professional, there'll be some folks that maybe my situation doesn't warrant a tax professional, and I think if that's the case, I would recommend a tax professional. But some situations, like I remember when I'll date myself again. I remember when I was young enough that it was a 1040 EZ form, and you literally dialed in, like on your phone by numbers, your adjusted gross income, and you literally filed it by phone.
Maybe he is above 50.
No, I can't say much. I remember the 1040 easy,
Yeah.
and like what we talked about last episode with different apps for budgeting and cash flow and net worth. I mean, there's software.
There's help out
There's
there.
help out there. There's softwares and tools for tax planning, and as well as too. And it's just making sure you're capturing on opportunities, and as well as your situation changes, you're doing the steps to make sure that you're aware of all the things that you need to be aware of.
Okay. So I think we've taken sufficient detours. We've taken a sufficiently long enough trip.
What do you think? 100? 4 sets of 25?
A day?
Yeah.
Okay.
You think that's a good?
Are you working
That's
to that,
insane.
or are you already doing that?
I'm already doing that.
Oh, you're already doing 4
Yeah.
sets of 25.
Well,
Okay, all right.
Is that enough to get Troy
That's enough you have my interest.
Okay. Well, then we will check in mid-year and see how we are on some of these. Yeah, 4 sets of 25.
That's insane.
Just actually after every meeting, you just get up, bang out 25, and go to the next meeting.
I can't even do one.
Well, okay. That's a whole nother episode, another story.
All right, I like it.
So let's go ahead and recap and say goodbye to the to the listener. So it's 2026 and it's here. What do you do now? Probably if you're thinking about anything, I would do it's like basic sort of blocking and tackling. To have a football reference, it's sit down and sort of get over I got to do a budget. Yes, you got to do a budget. It's deal with the cash flow statement. What did I actually do? It's looking at the report card and going, I want this to go up and not down or stay flat. That'll allow you to do things like prepare and allocate those extra dollars to emergency accounts and travel funds and
midterm and long-term goals.
Midterm and long-term goals, retirement. That's how you get to these things. And then obviously when we think about how taxes can come into play, we can be more efficient from a tax basis going into the next year, which again sort of feeds into that cycle of creating excess dollars that I can deploy, especially if I know where they are and where they're going.
And right? By the way, along the journey, making sure you have the right insurance coverages in place to make sure that protection is there, from life insurance, disability, income insurance, health insurance, property and casualty, all of that we talked about. It's making sure that protection, that risk management tool is being utilized to the right for the right amount of coverage for your particular situation.
Dig that moat. Right, yep. Dig that mode. It's not exciting, but man, when it protects you, you are so happy it's there. Yep. Okay, so I think we're going to end there. I want to thank both of you. This was a fun two-parter. So I want to thank everyone for their time and attention, and I want to remind everyone of a couple of things. One, I need you to like and subscribe to this episode, and go back and check out our other episodes, especially ones from well, I guess not especially but from season 1. There was a lot of good information, and we want you to go back and check that out. If you want to make sure that you're notified when a new episode comes out, you like and subscribe. And then I want to remind everyone, every 5th episode, we did one at episode 15. We're going to do another one at episode 20. We do a listener episode, and the way you get those listener questions to us is in the is in the comments of the episode. So look just below. You can comment. You can ask a question, and you may hear that question on one of our future listener episodes. So listener episode. Well, actually, like and subscribe. Go back and look at the other episodes from season 1. If you have a question you would like us to address on a future listener episode, you can certainly do that by commenting and asking your question below. All right. Thanks, everyone. This is Troy Branch. This is Future Focus, a financial strategies podcast. Thanks, and have a great day.